Today in accounting A level, I want to talk about capital gearing and its implication. So the capital structure of a company has a significant. We want to talk about capital gearing and its implications. First, the capital structure of a company has a significant effect on the financial stability and the future success of a company in the long term. So for capital gearing, we're talking about the long term. It measures the relationship between the long-term borrowing and the long-term borrowing of a company and its equity. Therefore, we can say capital gearing is the fixed cost capital divided by the total capital employed into the business. So how do we get that? So here they said the ratio for capital gearing is gearing percentage, which is the fixed cost capital. When we talk about fixed cost capital, we're talking about debentures, long-term loans, or preference shares. Because these ones have fixed interest. Debentures, for example, debentures, it has a fixed interest rate. We have preference shares, which has a fixed dividends that has to be paid to shareholders. So these are fixed cost capital. Then we have total capital employed, which comprises the equity. And when you talk about the equity of a business, we're talking about the reserves, we're talking about preference shares, we're talking about ordinary shares, we're talking about long-term loans, and we're talking about debentures. Put the summary of all, the sum of debentures, long-term loans, preference shares, ordinary shares, and all reserves brings up our capital employed. So with us, that means the fixed cost capital, which is the dividend, which is the preference shares and long-term loans or debentures divided by the total capital employed gives us our gearing percentage. You multiply it by 100. So what are the implications of this? So when we talk about the implications, we're talking about what we have to do as a business when we have to increase our gearing ratio or when we have to reduce our gearing ratio. So to increase our gearing ratio, to increase or to decrease the gearing ratio, it is decided by the company's director. So for us to increase our gearing ratio, what do we have to do as a business? So the first thing we have to do as a business, if we have to increase our gearing ratio, is to increase our debentures. So if we increase our debentures, that means we are having more debt to pay as a business. Another one to do is, one is to increase our debenture. Another one is to increase, to issue more preference shares. Because if we issue more preference shares, we're going to incur more debt. And the third one is to redeem our shares. And that's what we're going to talk about share redemption. And for share redemption, it means we have to pay from our reserves. That reduces the amount of reserves we have. We have to pay from our reserves to those shareholders that we already have agreement with to buy back our shares. So that also increases our gearing. But to reduce our gearing ratio, one, we have to issue new shares, which means we have to issue more ordinary shares. Also, we have to retain profits rather than paying dividends. That's another way to reduce our gearing ratio. And the last one is to redeem our debentures. So we stop paying for debentures, we pay off our debentures. So these are the ways in which we can increase or reduce gearing ratio. And also for the gearing ratio, we have a question here, which comprises which compares two companies, LG PLC and HG PLC. Here they said LG PLC has 12.5% debentures, and HP PLC has 12.5 debentures of 50 million. HG has 310 debentures. For the preference shares, they have 100 and 390. Ordinary shares of 500 and 100. Retained earnings of 200 and 250. General reserves of HG has 50, and foreign with exchange reserve is 250. So for the gearing ratio, it is fixed cost capital debt, which is capital divided by the total capital employed, which is debt plus equity. So for fixed cost capital, it is debenture plus preference shares. And for total capital employed to be debentures plus preference shares plus ordinary shares plus retained earnings plus general reserve plus foreign exchange reserve. They multiply by 100 gives us our gearing ratio. That is how we calculate for our gearing ratio. Thank you. So that takes us to talking about merger, which is another topic entirely. So for merger, okay, Let's just take it in the next class.